Welcome back. In this video I'm going to talk about the basics of the dividend discount model. We have 4 other videos, all related to valuing stock using the DDM model. Video number 2 is about the constant dividend growth model. Video number 3 is about changing growth rates. Number 4 is about total payout. And in video number 5, I'm going to give a summary. In this slide, I'm going to discuss valuing stock using the DDM model. The law of one price states that the value of a stock is equal to the present value of the dividends and future sale price the investor will receive. Because these cash flows are risky, they must be discounted at the equity cost of capital, which is the expected return of other securities available in the market with equivalent risk to the firm's equity. So the law of one price is telling us that the price of a stock at T0 is equal to the future dividend payment plus the future expected price divided by the cost of equity. When all the investors have the same beliefs, and if the stock price is actually less than this amount, so it's undervalued, expect investors to buy it, which will drive up the stock's price. It also goes the other way around. So if all investors have the same beliefs and the stock price exceeds this amount, then it would be overvalued and selling it would cause the stock price to quickly fall. The total return of a stock is equal to the dividend yield plus the capital gain rate. And the expected total return of the stock should equal the expected return of other investments available in the market with an equivalent risk. Let's look at example number 1. Suppose you expect biotech to pay dividends of 56 cents per share in the coming year and trade for 45.50 per share at the end of the year. If investments with equivalent risk to biotech stock have an expected return of 6.8%, what is the most you would pay today for biotech stock? And what dividend yield and capital gain would you expect at this price? Good luck. Let's have a look at the answers for example 1. We are going to use the equation that we have used in the previous slides. The first dividend that we're going to expect is 56 cents. The expected share price 1 year from now is 45.50 and the cost of equity is 6.8%. Filling this in the equation will give us a share price at T0 of 43 euros and 13 cents. At this price, biotech's dividend yield is the first dividend payment, which is 56 cents, divided by the current stock price at T0, which is 43 euro and 13 cents, gives us a dividend yield of 1.3%. The expected capital gain is the expected share price at T1, which is 45.50, less the current share price at T0, which is 43 euro and 13 cents, gives us a capital gain of 2 euro and 37 cents. Therefore, at the price of 43 euros and 13 cents, biotech's total expected return is 1.3% plus 5.5% makes 6.8% in total, which is equal to its equity cost of capital of 6.8%. Let's have a look at example number 2. The US food division of Ahold Delhaize is expected to pay dividends of $1.92 per share in the coming year. You expect the stock price to be $85 per share at the end of the year as well. Investments with equivalent risk have an expected return of 11%. So the cost of equity is 11%. Two questions. Question 1. What is the most you would pay today for Aalde Hesse stock? Question 2. What dividend yield and capital gain rate would you expect at this price? Good luck. So first we're going to calculate the price at T0, which is the first dividend payment and the expected share price. We're going to divide that by the cost of equity. That will give us a share price at T0 of $78.31. Then with this stock price at T0, we can actually calculate the dividend yield, which is the first dividend payment divided by the stock price at T0. That will give us a dividend yield of 2.45%. And then the capital gains yield, that is the expected share price 1 year from today, minus the current share price at T0, divided by the current share price at T0, gives us a capital gains yield of 8.54%. And finally, the total return, which is the dividend yield, plus the capital gain yield, makes a total return of 11%. And note that the 11% total return is equal to the cost of equity. Now, what is the price if we plan on holding the stock not for 1 year but for 2 years? Okay, when investors have the same beliefs, the dividend discount model states that for a time window of 2 years, the stock price would satisfy the following equation. That means that the price of the stock is equal to the present value of the first dividend payment, the second dividend payment, and the expected stock price at the end of year 2. Now, what is the price if we plan on holding the stock for any number of years? Well, the same applies here. When investors have the same beliefs, the dividend discount model states that for any horizon n, the stock price satisfies the following equation. In sum, if the stock eventually pays dividends and is never acquired, the dividend discount model implies that the stock price equals the present value of all expected future dividends. And this is the framework of the dividend discount model. This is the end of this video. My suggestion is to open the next one, which is called Constant Dividend Growth Model. Thank you.